We are delighted once again to have Danielle DiMartino Booth, founder and CEO of QI Research, on with us to talk about the economy, to talk about a lot of new things that are coming up that are going to be of concern to Fed Chair Powell, who's on the Hill today. Delighted to have Danielle. And I think, Danielle, aren't congratulations in order? I think you just recently celebrated your 10th anniversary for QI Research.
Yes, it's hard to believe that in June of 2015 I walked out of the Federal Reserve, and boy, that was a great day. But no, 10 years later, I'm delighted that we're still publishing every day.
You didn't even take a break. You walked out of the Federal Reserve and started QI Research.
I did. I published. I literally published 5 days after leaving. I published my flagship first weekly Quill. I don't know why I'm remembering right now because I haven't thought about it in years, but it was called the Great Abdication. It was Congress abdicating its responsibility to the Federal Reserve and not making, not making fiscal policy to grow the private economy. So here we sit 10 years later and gee, so much has changed.
It has, hasn't it? I mean, so much. What a weekend we had. And it feels like, Friday, we last spoke on Friday and it feels like an age ago.
I know. And you would never think that if you looked at West Texas Intermediate oil prices, that they would be lower today than they were Friday. I mean, what a crazy roller coaster.
I'm looking for the other shoe to drop in terms of oil prices. I mean, it's hard to see peace breaking out in the Middle East, right?
I actually, we're not supposed to talk about oil or anything like that, but let me just throw some unconventional wisdom out there, which is my favorite sword. Mm-hmm. And that's, a lot of countries in the Middle East have been really hamstrung by the constant situation in Iran, really keeping tensions brewing. And, it was an interesting take that a lot of countries now are going to have an easier time exporting oil and that this could actually be, kind of an economic sigh of relief for a lot of countries in the Middle East.
You're probably right. I think you're absolutely right. I think the oil prices may be, if peace does indeed hold, at least for some time, oil prices were in a downward trajectory, and it looks like it may certainly resume that. It's just such a surprise that, the president was, entertaining. Well, I don't know if entertaining is the right word, using profanity at 7 a.m. in the morning on his way to NATO.
Yeah. Well, and yes, we don't want the president using profanity for any reason because we know that he acts on his impulses.
Yeah, you're right. You're absolutely right. Because I think when you become profane, you actually turn to your worst impulses. But let's go talk about somebody who's a lot less profane, thankfully, which is Chair Powell. He's on talking to the House of Representatives today. And before we get to his sort of testimony, it looks like the winds may have shifted a little bit. We talked about it recently, but Waller indicated, he could be, ready sooner rather than later. Michelle Bowman came out and said, seems to say that July's a possibility. Austin Goolsbee, who's a voter this year, said the same thing. So now we have three people saying, we might be okay with July. So are the winds starting to shift on the Fed?
I think they are. This morning, we saw from Case-Shiller, for example, the second consecutive month of falling home prices nationwide. These are very lagged indicators. That this was for April, but March and April are, last I checked with the National Association of Realtors, they call that peak spring selling season. So to see home prices falling in these months is quite extraordinary. Everything we've heard about the month of May, we're going to see a third consecutive month of home prices declining. I bring that up because for all of Chair Powell's concerns about inflation, shelter's the largest input by far. More than a third of most any inflation indicator that you can cite. And it's clear between apartment rents coming down and home prices beginning to fall that the largest input to inflation metrics is going to be a drag. And it's going to be a drag for some time to come. So maybe that's where Bowman and Goolsbee and Waller, maybe their thinking is grounded in their other employment mandate superseding that of inflation if the largest input has got a negative sign in front of it.
I love your piece. Was it yesterday about the Kubrickian stare down?
Yes.
That was really quite lovely. It was described so well, sort of under your brow, staring at you. And so Do you set at what point, and you were a Fed insider, at what point does it become sort of untenable for Powell to say, I want to hold the line, I want to hold the line through the summer, through Jackson Hole into September? Does it, how does that dynamic work where he goes, you know what, I can't do the Kubrickian stare down anymore?
Well, that's a really good question. And until Goolsbee had raised his hand, and of course you're right to point out that he's a voter this year. Bostic came out this morning and said, well, we can wait. Well, Bostic doesn't vote until 2027. But if it was just Waller and Bowman in isolation, each of them, for the first time since 2005, have been dissenting Board of governors. And that was extraordinary to see, right? The first time in 20 years where we have a governor dissenting against the chair. And both of them have dissented. So, the cynics on Wall Street might say, they're trying to curry political favor. They're looking out for their future. But you do not want to be Chair Powell and have 3 dissents or more at any meeting, because that in and of itself is a signal to the markets, to people following the economy, that the Fed is no longer, the Federal Open Market Committee is no longer speaking as one voice. And that means that you're beginning to lose control in terms of your leadership capabilities.
Right. So I guess this PCE on Friday could actually be quite fairly meaningful in terms of whether the pendulum swings more in terms of July now rather than September. Now, I wanted to actually move to something you posted about a lot this morning on X, which is warn notices. And you posted quite a few warn notices, which, if you could just tell the audience what warn notices are briefly.
Sure. And the reason we're following warn notices is because they're running at the fastest pace since the Great Recession, 2007 to 2009, nationwide in the aggregate. But the reason we aggregate the numbers is because warn notices are it is the minutia of economic data. If a company knows in most states, let's say, that they're going to be laying off 100 employees or more, then again, every state has slightly different laws, but most states require companies to file a warn notice with them such that employees are given 60, 90 days of warning prior to losing their jobs so that they can plan for the future. And again, when you aggregate these warn notices, we really are seeing them at the highest level. And that means that whether you're talking about a plant closure that affects 321 individuals, that was one of the warnings that I posted this morning, but I posted 7 different ones from really various distinct industries. There's not a theme here. This isn't late 2023 when Amazon starts this trend in Silicon Valley and it's laying off middle managers and it's kind of isolated to one geographic area and overhiring during the pandemic. That's not what we're seeing in the warn notices. We're seeing distinct geographic cutbacks, headcount reductions, and we're seeing it across many different industries with, ironically, Michigan leading of all states, right? Michigan, after Nevada, has the highest state unemployment rate. And we saw the highest number of initial jobless claims in the week ended June the 24th coming out of Michigan. That's not exactly what President Trump, that's not how the script he's written should be reading, because he is, when he was campaigning up to the presidential election, he was talking about creating jobs in manufacturing. And we're seeing the exact opposite of that occur.
I noticed a couple of things that you posted really drew my attention. One was Hyatt taking out 30% of their service people. Maybe I don't want to stay at Hyatt. If I have an issue, it might be a little difficult to get help. And then the other one that struck me, and the word that you use, it was certainly striking, is Career Builder and Monster, file for bankruptcy. And I don't know the story behind it, but you said that their business was shriveling, and these people are, sort of help you to hunt for jobs. So it seems like, it seems to suggest that not so many jobs are available.
It's interesting you raise that point because obviously we live in a different world than when Monster and Career Builder first came to be. There's obviously more people who look to LinkedIn or Indeed.com. But seeing that big Chapter 11 filing this morning, I looked at the Indeed.com job postings, and they're indexed to basically the advent of this explosion in hiring that we saw after the economy reopened in 2021. And the index now is at 105, meaning we're just within a whisper of falling all the way back, of getting rid of all of the excess demand for labor that we saw in the post-pandemic era, unwinding that. And typically what we see, we call it reversion to the mean. I know you know exactly what I'm talking about, but typically when we have a reversion to the mean, we also end up correcting more to the downside before there's a stabilization. And I think that that's exactly what we are experiencing. Countless U.S. companies are suffering margin squeezes. It's not that the tariffs don't exist. It's that there's an inability to pass along higher prices, higher input costs to consumers because there's simply not enough money. We have record numbers of Americans working multiple jobs. We've got record number of Americans working in the gig economy, which does not pay benefits for the most part. And so in this type of an environment, aggregate income begins to decline. And that means that companies don't have pricing power because consumers don't have purchasing power.
And that leads into another story that I saw this morning. I just want to get your take on it. TransUnion, the credit agency, is reporting that, for the pandemic, people didn't have to pay their school loans for a long time.
More than 5 years, yes.
Right, which perhaps is too long. But now it seems to be time to pay the piper. They're reporting that 2 million American, who owe these loans to the government, or would be 270 days past due. So they're in default, and they're going to get their pay docked starting in July. I think there's 2 million in July and more in August and September. And the dock could be 15%, which seems like, I don't think a lot of these folks, if they're not already paying their loans, I don't think they have 15% to be done. I mean, that's going to come out of somewhere. It seems like it's a big number.
It's an effective pay cut, isn't it? And as we know from the Department of Education, wage garnishments do start this summer, and they anticipate that by the end of September, that a total of 9 million Americans will be at least 270 days delinquent on their student loans. A good friend of mine, John Comiskey, does extraordinarily great analysis at the intersection of Fannie Mae, Freddie Mac, FHA, VA mortgages, government-backed mortgages. But he does good work at the intersection of mortgagors and student loan borrowers. And his back of the envelope, and I say that tongue in cheek because he's done meticulous calculations, but from a starting point, if the big, beautiful bill passes in its current form as it pertains to student loan borrowers and further restrictions on extending and pretending government-backed mortgages, he thinks that by the time we get to the beginning of 2026, there'll be 4.8 million Americans with government-backed mortgages that are going to be facing a large income shock due to those student loan repayments. So the reason I bring this up, Tai, is that because we cannot look at student loans and how they're going to affect U.S. household budgets in isolation. We have to consider them in conjunction with the fact that so many Americans in recent years have taken on mortgages where before they were living in city centers and they were renters. They've taken on auto payments for the first time because they moved outside of city centers, and they've racked up buy now, pay later, but to a much greater extent, credit card debt. So they've got to juggle all of the debt service. That was one of the extraordinary takeaways from 2024, is that on whole, in the aggregate, Americans were spending more to service their non-mortgage household debt than they were to service their mortgages. We'd never seen this in the history of the United States. But what that tells you is there's a lot more non-recourse debt that's sitting out there than there was 5 years ago. Millions upon millions of student loan borrowers have been operating under the assumption that they would never have to pay these loans back. So this is what we call a classic income shock. And it's TransUnion figures that on average FICO scores have dropped by 60 points. But when it comes to higher income individuals, and I always use the example of an oral surgeon, the average oral surgeon in the United States has $469,000 of student debt. But when it comes to higher income earning Americans, that income shock is going to be appreciably bigger, and the hit to their FICO score could be up to 150, 200 points. So this is real economic nuts and bolts that we're talking about that, by the way, Chair Powell knows exist.
So, let's put you in the seat of the Fed chair, and maybe that would be a nice next gig for you. I dare say that it will probably pay less. The Fed chair would pay less than what you do as CEO of QI Research. But where do you think the Fed funds rate ought to be at this stage in the cycle right now?
So I think that it's pretty apparent that because the Fed funds rate is above so many other benchmarks, that I think we're at least 100 basis points, 1 full percentage point away from where we should be at this juncture. Now, I need to be really clear because I get a lot of flack on what we used to call Twitter because Danielle wants to go back to the zero bound. She wants to restart quantitative easing, money printer go burr. No, I don't. I think that the Fed funds rate new floor should be 2% and never should it be breached again. And I don't agree that quantitative easing should ever be started up again. I think they're both abject failures that encourage speculation and have proven to be kind of a non-starter when you're talking about the real economy. So I need to be very clear that I believe the Fed funds rate is too high, but I don't think that it should fall much more than 200 basis points in total in any economic downturn.
That makes sense. It's sort of, let's get away from the bad habits. Like people have had bad habits like, we won't have to pay our student loans ever. So we'll go and take on some more debt and service those. And then eventually the piper comes calling, which seems like, we're going to do in the next quarter or so. Staying with the Fed for a little bit, there's been talk about about Trump appointing a successor to Powell, almost a year before he's due to go. And that seems sort of like perhaps not the best idea, but, just to have sort of a shadow Fed chair. But what are you thinking? It seems like, is it between the Kevins, Kevin Hassett of, formerly of AEI, now in the administration, and Kevin Warsh, who, maybe a bit more of a hawk than Trump thinks he'll be?
So there's a lot going on here. The thing that I would say is on the side of the markets is that Trump likes to take his time making any decision. I'm going to be announcing X, Y, and Z in 2 days, and 48 hours later, make that 2 weeks, and 2 weeks later, make that 2 months. So I think he loves to play cat and mouse with the media. But the long story short is here we sit, it's almost July. What people are not talking about is the fact that Adriana Kugler's term ends on the Federal Reserve Board in January. So whether he wants to name a potential shadow Fed chair tomorrow or wait until the last minute before Powell's term as chair is up come May, he's going to have to announce somebody in the fall to come after Adriana Kugler and fill that position. And that's the fact. So you're right, though. There's a certain irony in the fact that there's reams of opinion pieces and papers that Kevin Warsh has written that they're very much against quantitative easing. He does believe that's a failure. He doesn't believe in the zero bound. And, maybe somebody's going to be whispering in President Trump's ear. He might not be your guy. Maybe it is Kevin Hassett. We will see. Maybe it's going to be Scott Bessent. But Scott Bessent surely wouldn't be raising his hand to take Powell's position if it was going to be a demotion effectively to step down from being Treasury Secretary of the United States to being on the Federal Reserve Board. He would only have that be a lateral move if he's still in the running. And then we're talking about next May. Regardless, by January, Congress is going to be voting on confirming somebody to replace an individual for a 14-year term on the Federal Reserve Board. That's a big decision for Trump to make because you leave longer lasting impacts on the Federal Reserve Board and on its leadership when you appoint someone to a new 14-year term.
Certainly. I mean, I think that's a really good insight. Um, in terms of, and you think that, the Fed governors aren't like the Fed presidents. I think the Fed, presidents of different places actually, make a pretty decent living, but the Fed governors are, limited. They probably make $200,000 a year. And, a lot of people are like, do I really want to do that? And certainly I think the market might not be happy if Bessent were to go, and not be Treasury Secretary, because then who's going to be Treasury Secretary?
Right. No, and that's the catch-22 here is that, I think if market players, if long-term market veterans had their druthers, they would just clone Scott Bessent and call it a day, and they'd keep him in both positions because he is considered to be a very level-headed, calm, thoughtful leader, and you want that person to be Treasury Secretary, and you want that person to be chair of the Fed. So we'll have to wait and see. But I do think somebody like a Kevin Hassett, I think somebody like a Christopher Waller is also clearly an individual. He was chosen by Trump. We forget that initially appointed to the Federal Reserve Board. Trump could certainly pick him from within if he chose to do so. But again, I will reiterate, Waller was the first one to come out when he was first appointed to the Federal Reserve Board and say, why are we conducting mortgage-backed securities, QE? Why are we easing in the housing and credit markets? That's not our business. That's not our place. So he would not be advocating for the most dovish of behaviors as chair of the Fed. And again, I don't think that these are very open secrets, Tai. I think somebody's going to be whispering in his ear. And if I'm Trump and I want somebody who is going to advocate for everything that I criticize, QE, the zero bound, blah, 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 you want to appoint a malleable yes man or yes woman to do your bidding. And again, we don't want that as head of the Fed anyways. It's the Supreme Court has just carved out effectively in its ruling the Fed's independence and indemnified that. We need to maintain that.
Absolutely, for the confidence that we need in our financial system, with all the things that, all the concerns about long U.S. bonds and debt. Well, certainly a steady hand at the Federal Reserve, and the Federal Reserve itself is, and you make a very, very good point. Well, thank you so much for being with us today. Look forward to speaking again very, very soon.
Absolutely, Tai. I always enjoy our discussions. Thank you for having me.